Hello and welcome, ladies and gents. Thank you ever so much for joining us for this tech panel session. My name is Peter Higgins, and I'm delighted to be here to moderate this panel for you. I've got three stellar guests for you in the form of Kirsty Gibson, co-manager of Baillie Gifford US Growth Trust, Tim Levene, CEO of the UK's only publicly listed fintech-focused investment company, Augmentum Fintech, and you hopefully have earlier seen Mike Seidenberg, the lead portfolio manager of the Allianz Technology Trust. We're going to do a slightly different panel for you to enable you guys and ladies and gents that have come to see us in person and online to ask as many questions as possible. So we're going to ask each individual to come up for about 3 to 4 minutes and deliver an overview of what they do, and then talk about the main question of the day, which is technology, the next big thing, and where do they think we as investors could profit from it. And we're going to take a Q&A after each one, and then we're going to leave hopefully a little bit of time for a bit more Q&A after that. So without further ado, because we're going to be running against the clock here, we're going to ask Kirsty Gibson to start first. So hello, Kirsty, for you.
Thanks.
Go for it.
So, hello everyone, my name's Kirsty. As Peter said, I'm co-manager of the Baillie Gifford US Growth Trust. We are looking to invest in exceptional growth businesses in the US, and they can be both in public or private markets. We can own up to 50% of the portfolio can be in private companies. So the technology I'm going to talk about today is automation, which is being enabled by artificial intelligence, robotics, and advances in engineering. And I think the best way to illustrate this is to talk about some examples of companies that we have within the Baillie Gifford US Growth Trust, just to show you the breadth of different businesses that are using automation and autonomy to their advantage. So the first is actually a company called Sweetgreen, which is a salad chain in the US. It has around 200 stores, and it's in the early stages of rolling out a product that it calls its Infinite Kitchen. The Infinite Kitchen is robotic salad assembly. Now, that might not sound particularly exciting, but it's pretty impressive, and it's much more than a gimmick. This is a business where margins are very important for restaurants when they're doing rollouts, and there's a lot of potential with the combination of this Infinite Kitchen for Sweetgreen to drastically improve its margins. So the restaurants that have this Infinite Kitchen fitted see margins that are 10 to 12 percentage points higher than the average of the restaurants that they currently own that don't have them fitted. And with 50% plus of their restaurants going forward going to contain that Infinite Kitchen, you can see that there's a potential here for automation to play a really big role in driving the long-term returns of this company. We also own a business called Aurora Innovation. So we owned Aurora as a private company and have continued to hold it as it's been listed as a public business. It makes software for autonomous trucks. I have been on one. It took me down the highway for 45 minutes with nobody driving it. It installs its driver into a truck, and then that truck drives itself. Potential efficiency gains for this industry come from the fact that it's a very highly regulated industry where individuals, truck drivers, are only able to drive for certain amounts of time before they have to have breaks. Obviously, with a sort of robotic automated truck, that's not the case. It can theoretically drive as much as it likes within one day. There's also the fact that there's a great number of driver shortages in the US as well, because it's not a very appealing career path for many people anymore. So they need alternatives in order to be able to match the level of demand that they're seeing in trucking. The company also has a very impressive list of partners, and its commercial launch is expected in the first quarter of 2025. We also own a private company called Zipline, and I mentioned this one in my morning presentation, but it's an autonomous delivery. It has autonomous delivery drones, which have made huge progress flying medical supplies in various countries across Africa, but they are also in groceries in the US, and they have a relationship with Walmart, flying people's groceries to them in their house via drone. We have another company called Neuro. Neuro is a private company as well, whose small purpose-designed, small autonomous vehicles deliver food and other products curbside to people's homes, and they're doing this in various cities across the US. And then a few other names to throw out there. SpaceX. It has its self-landing rockets. If you've not seen them, I would advise having a watch of one of those on YouTube. It almost doesn't look real, the fact that these things slow down and that they land themselves. And then we have Tesla with their announcement yesterday with their robo-taxis and their Optimus robots too.
Thank you very much, Kirsty. Now we're going to take some questions from the audience, if you've got a question. Anybody got a first question for Kirsty? Not at the moment. Okay, Kirsty, I'll ask you one of my own. Are you ready? So I've got a question here for you, which is about the Baillie Gifford US Trust. The teams are shrewd observers and investors in second-order effects big technology shifts, correct?
Yes.
Okie dokie. Please, can you firstly share an example of such a second-order effect? And secondly, a listed company that you, Baillie Gifford, have invested in respect to that, please.
Yeah, so I think about something like artificial intelligence is a really good example of that at the moment. Like, I think there's a lot of focus at the moment on these infrastructure players like the Nvidias of this world that we obviously are invested in as well. But, the second order effects of that for a company like Duolingo, which is allowing them to be able to create improved language learning. So Duolingo used to think that it would take around about 15 years for them to get to the same equivalent as having a one-on-one tutor. With embracing artificial intelligence, they think they can bring that down to 5 years to be comparable to a one-on-one tutor. And that's because they've been able to introduce an AI that you can now talk to and you can now communicate to. And that AI speaks to you and has a conversation with you. It doesn't just ask you to order coffee in French like we've all sort of practiced when we were younger. It is communicating with you based on what you say. It remembers what you say. And it also talks at a pace that reflects the level of understanding that you have of that language. Or we have something like a Shopify, a Canadian-listed business, which is a technology platform for entrepreneurs. And the interesting thing is they've made a huge pivot in terms of their investments that they've made into artificial intelligence to say, we're going to harness the power of this and basically bring the power of consulting to small businesses. So if you owned a small business that sold skateboards in the summer and you sold snowboards in the winter, if you want to change your website to be able to accommodate that, you have to, at various times in the year, upload the new photos, change the pricing, etc. With Shopify's new tools, what you'd be able to do there with a product called Shopify Magic is you, using natural language, would just be able to type in, please change my website from skateboards to snowboards. And based on your pictures that you have saved, based on the inventory and your pricing, etc., it would be able to do that for you, and you wouldn't have to do it yourself.
Thank you very much for that reply. Do we have any other questions from the floor? Please. Thank you.
Hi, thank you. I heard your presentation this morning. Very impressive, so thank you.
Thank you very much.
Early stage businesses, you normally expect to get one superstar, and we've heard a lot about, the 90 businesses that are responsible for 50% of the growth in, the US stock market, etc., in any period of time. You're obviously trying to back winners, but normally, when you're doing early stage, you expect at least 2 or 3 of them to go bust. So, and 1 or 2, one to be the superstar and give you 100 times your money. So what are your percentages, or what are you banking on? Yeah,
so we don't actually do early stage. So the private investments that we do make are usually businesses which maybe 15, 20 years ago at this point would be public, but they're just staying private for longer. And one of the reasons they're staying private for longer is because they can raise money, the necessary money that they need to raise in the capital, in the private markets. They can do that without listing. And so we're probably in those last couple of stages before a company goes for an IPO. So I think I just want to make that clear that we're not going for the early stage. You are correct though that you are not going to pick every winner. And but I think in terms of hit rate, I don't have the numbers to hand that I can share with you. But I think what's really important to remember is that you can only ever lose 100% of your money in a stock. But you can make so many multiples of that if you're right. And I think, so a really good example here would be something like an Nvidia. So the Baillie Gifford American Fund, not the trust because we hadn't founded it then, but the Baillie Gifford American Fund invested in Nvidia in 2016. Until about June of this year, that had returned around 40 times the initial investment for our clients over that period of time. Now, that's a very big delta that, getting a few of those really right. So it's how much you can make for your clients, how much money you can make for your clients when you're right that really matters, as opposed to worrying too much about the ones that unfortunately don't work out.
Brilliant reply, Kirsty. Thank you ever so much.
Thank you.
Thank you. Now, ladies and gents, we're going to hear from Tim Levene, CEO of the UK's only public listed and Europe's leading publicly listed Fintech fund. Over to you, Tim.
Thank you, Peter. I'll time myself for 4 minutes. Good afternoon, everyone. My name's Tim Levene, and I've been in the UK and European tech venture ecosystem for 25 years. So I was an entrepreneur. I was one of the original team of a business called Flutter, which became Betfair, and is now known as Flutter and trades in New York as a $20 billion or so business. So I've seen how our sector, our industry, has scaled dramatically over the last 25 years. Just over 10 years ago, I was backed by Jacob Rothschild and RIT Capital to tackle another industry in financial services, which post-financial crisis was seeing the first opportunities of true digital transformation. The first fund returned a 19% IRR, and in 2018, I listed Augmentum on the main market in London. Today, we've got 26 companies in the portfolio. We typically invest at what we define as a Series A. So early, but not too early. Revenue generation, product market fit, typically. But as the gentleman alluded earlier, we are looking for that outlier opportunity. We are, I would say, halfway through the first real journey of the fund, despite the fact that it's a permanent capital vehicle. We're 5-6 years through. We've already returned over 100 million of the 200 million we've put to work. But really, we would expect those returns to start to come through in 2 to 3 years and then deliver those outsized high teens, low 20s IRR. So why financial services? Why fintech? Many investors, both prospective, existing, and those that sit on the sidelines, always talk about the hype cycle. The reality is, one of the takeaways I would love you to go away with is to understand where we are in that cycle and the opportunity ahead of us today. The global financial services industry is about $15 trillion of global revenue, depending on how you cut it. Gross margins operate 19-20%, so one of the most high profit margin industries and one of the largest globally. And yet, when you look at how much of it has been penetrated by digital disruptors, it's only 3 to 4% so far. Find me another industry that has disrupted as little as financial services on a global scale. Now, regulation has been a significant inhibitor of that growth. But we stand here in 2024, where global asset managers, banks, insurers, other financial institutions can no longer bury their head in the sand and ignore what digital transformation is going to do to their industry. Of course, many have tried, and in many cases failed to invest huge amounts of their own balance sheet into digital transformation. And the difference today, relative to where we were 4 or 5 years ago, was that there's a much greater recognition from those financial services incumbents to engage with the industry, to partner, to acquire, to invest directly in the next generation of financial services and businesses. So what should you be excited about? Now, I'm going to cheat a little bit and not necessarily just talk about a single technology, because if you pinpoint the fintech industry over the last 10 years, every year there is a hyped area, whether it's blockchain, whether it's buy now, pay later, whether it's AI. The reality is, for us, a lot of those underlying propositions and technologies are permeating throughout our businesses across the portfolio. We've been working with AI for over a decade. Many of our companies are fundamentally driven by AI, but we don't go out and talk to the market as if we're an AI fund. But it is essential that most, if not all, of our businesses are engaging with the next generation of AI. If I would pinpoint one sector within financial services, which you should keep an eye on, where technology will have a dramatic impact over the next 5 years, and don't look no further than wealth management, and look at the impact that AI is going to have on that industry in terms of improving efficiency and in helping transform many of those traditional wealth managers that are struggling to adapt to technology today. Our advice to many of those wealth managers, many of whom are shareholders in Augmentum, are adapt, embrace, or your business won't be here in 10 years. I'm going to pause there.
Brilliant cue there. Thank you very much, Tim. Do we have some questions for Tim, please? Okay, just want 2 at the front here, please. We'll go with you first, sir. Just here.
You talk about financial sector as being so very profitable. I'd express it as it's the most exploitative industry versus its customers. in the world. And I'd like to see customers helping each other, telling themselves the truth that minimizing costs matters and how to do so. Does that give you do you agree? And does that give you an opportunity?
So I would wholeheartedly agree with your point, in particular in many industries, and banking, wealth management being one. And I think in order to create more transparency, in order to reduce margins, you need increased efficiency. And I think inevitably, if you think about the profit pool in global financial services as something like $3 trillion, in our view, that profit pool reduces as the market becomes more efficient. The question is, what happens to that revenue pool? And I think I saw it firsthand in the betting industry when we were building Betfair, where you had 3 incumbents in the year 2000 that controlled 90% of the market and refused to engage and compete with Betfair, that was offering a much lower margin proposition, but grew the market overall, increasing transparency. And I think we're seeing that on a much bigger scale in the financial services industry. The challenge many have, and I think you'll see that in the wealth management industry as AI starts to take hold, and it's not going to be overnight, it's going to take 3 to 4 years, is how does a regulator react and adapt? Our view to the regulator is let the technology drive innovation and change. Do not create regulation that inhibits. Wait until you see those first signs of maturity. So if I look across our portfolio, I see a large number of businesses that arguably are creating financial inclusion, increased transparency, and much better propositions for consumers and businesses alike. And that I would say is the fundamental proposition of a lot of what we're looking to do and some of the companies we're looking to back. And I think we will see a very different industry in 5 to 10 years' time. And I think we've made a lot of progress over the last 10 years, and there's a lot more to come.
Brilliant reply. Thank you very much, Tim. We'll take another question now.
Thank you for your presentation this afternoon. But do you have another Flutter in your portfolio?
So the early investors in Flutter, or I should say Betfair, after the merger, made 500 times their money, and if they held on, they've made nearly 1,000 times their money. I think maybe you only get one of those a lifetime. We're on a journey. We've, to give you an example of a business that we backed early on and exited, we bought in our previous fund 10% of Interactive Investor for $2 million, and that business sold for $1.5 billion, so it wasn't a bad opening salvo. We have a number of businesses in the portfolio that are starting to really get to scale. So businesses we backed at $3-4 million of revenue, I can think of 3 off the top of my head that are now generating north of $250 million of revenue and are now profitable. I think ultimately the question is, what does success look like for us? I mean, we are building that portfolio effect. We're not going to have 100 businesses, but we think 25 to 35 is that right portfolio, and you can continue to recycle. If over the long term, we believe we can deliver, our internal target is to deliver at least 20% IRR, but you need to allow the portfolios to mature. So I'd like to think that we're seeing 3 or 4 in the portfolio that are really starting to break through at real scale, and you'll see the delivery on that in the next couple of years. And I would like to also think that we've got enough at the early stage where there are 2 or 3 potential examples that can really break through. And I guess answering the question that was asked before, not to me, what is that ratio? We are in the business of taking calculated risk. So we're monitoring 5,500 fintech businesses across Europe. We've built our own internal CRM system using a lot of different tools, including AI, to make sure we're keeping on top of what's going on in the market. That's linked to 14,000 different people in the industry. We also track individuals that leave some of the most successful fintech businesses across Europe. And we would get an alert if somebody had left Revolut, who was a product manager, and has gone off to do something new. That would pick up on LinkedIn that X has left Revolut and going to do something new. We would immediately tag that. So it's our job to filter the huge amount of noise in the industry that exists and really identify those handful of opportunities that could deliver those outsized returns. And we need to be able to kind of place enough chips on the table in order to have that calculated bet. And at the same time, we are saying no 99.8% of the time to the businesses we meet. So it is a really, really hard proposition. It's hard, and we would regard ourselves as experts, and we also get it wrong sometimes. we recognize we just need to get it right more than we get it wrong. And I think so far we've done that, but there's still a lot more work to be done. But I think each year that goes by, we are becoming better, more informed investors. And we've got to practice what we preach. We've got to use and leverage technology to make us as efficient as we can be, to allow us to get ahead of the others as well.
Brilliant. Thank you very much, sir. Great reply, by the way. And now we've got Mike Seidenberg going to speak about Allianz Technology Trust, and then going to be giving the questions to you. Go for it.
Great. Note to self, never follow a venture investor if you're a public market investor when you start thinking about returns. I'm the lead portfolio manager of the Allianz Technology Trust. I want to talk a little bit about cybersecurity today. If you heard my previous presentation, some of this may be a little bit, you may be hearing again. You know, when I was posed with the question about, you know, what cutting edge technology I thought had the most potential, you know, you can't really pinpoint it to one company because there are one cutting edge technology. I think in terms of subsectors, so I don't think in terms of a pure technology kind of, you know, being so relevant that I would be able to articulate that. But I do think in terms of subsectors, and when I think about cybersecurity and the threat environment and our individual presence, both as consumers and if you're a business, and how the network of opportunities for the adversaries to attack you continues to grow exponentially. I do think that is probably, I've said this previously, I think it's the best area in tech. I think it's the best neighborhood in tech from a durability perspective, in that you know, I'll be long gone and someone will still be talking about cybersecurity to investors in the trust, given that it's just a necessary area of spend. And the characteristics are such that, you know, not only do you have a layered approach, right, because we're living in a world whereby, you know, it can't just be a firewall, because inevitably the adversaries are going to break into that particular product. So you need multiple silos of products in order to protect the estate. And within that framework, one of the companies that I think is most interesting is a company called CyberArk. It did not return 15,000%. Hopefully, maybe someday. But you know, it is a company that basically handles privileged access. And if you think about that, what that means is, you know, given the relative importance of a digital infrastructure, anyone that goes near the heart of that needs to be monitored, right? They need to be able to see exactly what I'm doing if I'm in IT. So there's this process of auditing as well as protecting basically, you know, the crown jewels with something bad happening. And CyberArk is a company that did it initially on-prem, and now it's doing the same technology or the same framework in the cloud, and they'll do it again with AI workloads. So as you can see from a total addressable market perspective, it's really interesting in that good core technology, really trusted, easy to use in on-premise, their customers then start moving to the cloud. The same challenges that are associated with cloud workloads persist, you know, that they saw on premise. And now the third kind of leg of the stool would be AI workloads. And here again, you know, you have the adversaries that are just so incredibly smart. If you think about how people are getting breached, they're getting breached, in the example of Target, was through the air conditioning system. You know, where they were able to get in through the air conditioning system onto the network and then get into the heart of IT. So that's a single company that I just think has an interesting opportunity. There are other companies in the portfolio. I probably don't have enough time to go into them given the constraints here. But cybersecurity, I think it's worth, as investors, it's worth looking at that space and the companies that participate in that, given the increasing importance.
Thank you very much, Mike. Any questions from the floor? There's one just there, the lady there. Thank you.
Hi, Mike.
Hi.
Just on your point about cybersecurity, what are your thoughts on the necessity for sort of risk management in the industry, given sort of the CrowdStrike outage that affected so
Sure.
many industries and so many people earlier this summer?
Yeah, and I just want to clarify, CrowdStrike was not a breach, it was a deployment issue, which nonetheless was really painful. The challenge for organizations around security is that there are way more open jobs than there are people, so organizations need to become more and more efficient and make their people more effective. So to your question, I think that any product that can basically abstract the various risks and be able to look at that is a real win, because ultimately the real dirty secret, and if you go talk to, and I've talked to the CEO of Palo Alto, whether George at CrowdStrike, the real dirty little secret in security are false positives, right? Where we have a finite resource that's actually chasing after something that really isn't a breach. And therefore we're using resources while the bad people are getting in the back door, right? So the false, anything, I mean, one day there'll be a company that really can holistically deal with the false positive challenge. But I think, to your question, being able to abstract your various risks and to look to see where you're vulnerable is a great opportunity. I can't think of anyone that kind of has a product that does it today. But I mean, anything operational in the SOC, in the Security Operations Center, we're big fans of.
Thank you for that reply, Mike. Any further questions? Okay, Mike, I've got one for you, for myself here. I'm going to ask you about monolithic power systems. It's coming up for its 20th anniversary since their IPO.
Yep, just there 2 weeks ago.
There last, yeah. So 3 3/4 years of being an S&P 500 company as well. 9,315%. So you're not just bad considering Flutter and all the rest of it there, yeah?
Impressive.
How did your team decide to get involved with that
Sure.
particular company? Because it's quite a young company in itself,
Yeah.
in essence, but not a startup.
I mean, it's a great question. And like I said, we had our board in town 2 weeks ago, and it was one of the companies. It's perfect lead-in. I don't know if I need to pay you or...
Yeah, that's cool.
But we actually went to visit them a couple weeks ago, and it is such an entrepreneurial company. And when you meet with them, and one of the things I like to do is I like to meet with line managers. I think it's great to meet with the CEO and CFO, but when you meet with a line manager, you get to see how people think. And you know what? That's really driven from the corporate culture that is implemented vis-a-vis the CEO and the CFO. And I would suggest, my guess is you spend a lot of time thinking about how do you get an organization to go. And you can see the entrepreneurial spirit when you meet. We met with a line manager in the automobile sector. We got involved. It was actually the first position that I bought in taking over the trust. And I worked with one of my teammates on it, and I just wanted to get his thoughts about where the business could be in 5 years. I knew it was expensive. I was okay with that. I'm okay with expensive for great companies. And in doing the work, my conviction level became equal to his, which allowed us to make it a healthy position. I like to say that, when you find a great business, hang on to it and live within the cycles, meaning we're probably going to own it for a long time. Now, we're going to own varying position sizes because nobody executes perfectly, but the opportunity set and the fact that they've taken share both in up cycles and down cycles, the last 4 cycles, I mean, it's just hard to find businesses like that. I mean, look, I would love to find 10 like that. I'd be able to sleep at night so much better. You just don't, they're just hard to find, and they require a lot of work, and you have to be able to have a vision of how this is different than the world is thinking about it. But in monolithics power, the credit really doesn't go to me. The credit goes to my teammate, and I just kind of helped along the way. But, that's the type of stuff you live for.
Brilliant. Thank you for that reply, Mike. Thank you. Ladies and gents, that's the end of the presentation for the mainstay to the question. I'm going to open the floor now to ask any of the panel a question, if you wish. We've got 10 minutes, and then I've got some questions as well. Anybody wants to start with a question? The gent there in the light blue shirt in the middle, please. And please, can you state who the question's to, please?
Mike.
Okie dokie.
Sam.
Hey. Just for a representative corporate, can you just give us a sense of the opportunity in that company's budget for cyber to grow? What percentage of the IT budget is cyber at the moment for a representative large corporate?
Yeah, it's a great question. I think it varies depending on the corporate. I like to think of it as almost in the best way I thought, the best thing I heard regarding cyber budgets are when we were talking to the CEO of Palo Alto about a cloud workload. He thought that 1 to 2% of a dollar that gets deployed in the cloud should be going to cyber. Now, obviously, he has an agenda, so I immediately thought about 1 cent versus the 2. But on average, companies are spending, call it, 2 to 3% of revenues at times on cyber, depending on the industry. Obviously, it's going to be different, if you're a digital company versus, an oil and gas company. But the way we've really thought about it is to think in terms of as things move to the cloud, what's the overhead, which is a fancy name for tax. What is the cyber tax? And by the way, there'll be an overhead associated with artificial intelligence workloads as well. And the next question I asked him, I said, where are we today? And he basically said people are paying a quarter. So that gives, 4x bigger than it could be over time. If it came to fruition, that would put the cyber companies today, where I'd say they're kind of bumping up against the early low stages of large cap. That would create a lot of large cap space in that. There's the rough math.
Thank you for that reply. Further question? I'm going to go to that gent in the corner there. And whilst you're going over there, I'll ask this question whilst you're going over there, to the chap in the corner. And we'll give this one to all three of you. Well, I'll start with Kirsty. Kirsty, the US Justice Department said in court just a few days ago that it may recommend a breakup of Google as an antidote to unhealthy competition in the search engine market. It may also seek remedies of divestiture of Chrome, Android, and other players. Please could you share your thoughts on hearing that news 2 days ago, and what do you think may happen to Google? And is it, antitrust-wise, going to be impacting the ecosystem, etc.?
Yeah, I think there's been rumblings of sort of the idea of breaking up some of these large players for quite a long period of time. And so it's not new news from that perspective. I think the challenge with some of these antitrust cases is there's quite a lack of understanding. I don't know if anybody saw any of the interviews with the senators and the likes of Sundar from Alphabet when somebody asked him about the iPhone, and he had to tell them, well, I don't actually make the iPhone. So I think
he pays them a lot of money.
Yeah. So I think that there are challenges. I think Alphabet would be really quite a challenging business to potentially try and break up. How it's very interconnected. How do you decide how to slice that up, and who makes that decision? Something like an Amazon potentially. I think if the antitrust cases were, the eye of Sauron was to pass on to Amazon, for example, I think that there's a much cleaner potential case to be breaking that into AWS and the retail business. Now, are there advantages of them being together? Yes, we would argue that they are, but there is a much cleaner case for being able to break those potentially into two.
Brilliant, thank you.
Can I just add a point to that?
I was going to come to you, yes.
And I'm not trying to cut you off, Tim. I think the bigger issue is going to be how it impacts their business practices. Because if you go back and look at Microsoft, when they were under the spotlight of the DOJ, it really curtails how aggressive you can be, because you don't want to you don't want to add fuel to the fire. So my bigger concern is just what it means to their business practices going forward with respect to being, businesses want to be aggressive as possible without going over the line. I think it's negative to that, and I agree. I wholeheartedly, and we did not rehearse this. I wholeheartedly agree. I don't know where you break it up with Google now. With with Amazon's in the Amazon case, I think that if they broke it up, it would be really bad for competition in that you would, like anyone I know who works at Amazon, it is the hardest charging environment. So as opposed to having one, huge animal that would, run amok amongst people, you would have two. I mean, I think that would be great for shareholders because I think you'd have just massive appreciation in the two names.
Thank you. Tim, do you want to add to that? What have you got to add?
A little out my comfort zone, so I'll probably kind of...
Absolutely fine. Yeah, because my concern with the antitrust side of it, with what they're doing before with Microsoft and now trying to do with Alphabet, is the fact that innovation is driven by mergers and scale and size. So the whole ecosystem could be impacted going forward. So I didn't know your thoughts on the ecosystem and mergers and acquisitions.
I mean, we've, with the current administration, we've seen a real curtailment vis-a-vis M&A by the large cap companies. I think they really feel like their respective companies' hands are tied. I go back to the idea, and I remind myself this. IBM owned the mainframe market, right? There were lots of peripheral companies that establish big businesses around areas where they were inefficient, and we've seen that in tech time and time again. So I'm not worried about do they have to break up these companies because other companies won't emerge? There's always some entrepreneur with a great idea that goes to visit Tim, gets some money, and next thing you know, they're going up against a giant, and it's what makes capitalism great.
I think I'd add as well, it's really improved. If you look at someone like Meta, Meta faced a lot of criticism for the fact that was it really innovative because it acquired Instagram, it acquired WhatsApp, and then it was basically decided, no, you're not going to be allowed to acquire anything else ever again. And what did it do? Well, it released Reels to compete with TikTok, and it showed actually that we are a very big business, and we're also a very innovative business. And within X period of time, they'd caught up. They released the product to try and compete with Twitter or X, etc. And they've managed to do that. Reels. I think in November last year they said that Reels is a $10 billion run rate business. These are big businesses that they can within their own organizations as well.
And remember when they acquired Instagram, people thought they paid, they thought it was
too much.
Crazy.
It was only $1 billion. I mean, I think they'd like to have that trade back again, the Instagram founders. I mean, I think the one thing to say is to unpack it, to ensure that the regulators are stepping in when big tech are overreaching. Where, I have concern both here with the CMA and with the Competitions Authority in the US, is when they're stepping in actively for M&A, because ultimately we need that capital to recycle back into the ecosystem. And that is where they're doing a disservice to competition, because if the money's not getting recycled, we're not seeing that next wave of innovation. And I think that's the big question that we are, pushing the CMA to answer here. And I know, many of my peers in the venture industry are pushing quite hard in the US as well, and that's something to keep a close eye on.
Yeah. Brilliant. Thank you very much for that reply. We've still got that question in the corner. I'll come back to you, sir. Thank you for waiting.
To the whole panel, how do you balance your listed and unlisted portfolio, particularly with companies staying unlisted far longer than they've ever done before?
Good question. We'll start with you, Kirsty, please.
So ultimately, as I said at the beginning, actually I don't know who asked that question because I can't see it. There we go. As I said at the beginning, we can own up to 50% in private companies within the US Growth Trust, and that was a deliberate decision when we actually decided to IPO the company, to allow that flexibility and to say that we wanted this to be quite different from the American fund that we already run. In terms of how we allocate, it's about competition for capital. It's not, and we are not looking for exits from these businesses to happen in a certain period of time. The trust structure is so great because it is a permanent pool of capital provided by shareholders that allows these businesses, us to invest in these private companies and then not need to pressure them to say, well, we need an out at this period of time, or we have a limited life fund and we need to deliver back to our shareholders at that point. So we can own companies, like I gave the example of Aurora Innovation, we can own companies privately through IPO and beyond. Now, it might be that for some companies that at IPO, they've struggled when they've become listed businesses and we may not want to own them anymore. But the reality is we don't separate them too much in our mind. There is a slightly higher hurdle rate that we place on the private businesses just to reflect the fact that they are illiquid. And there's not an easy way to get rid of them if you own them and things don't work out as you expect them to.
Right, ladies and gents, we've got 40 seconds. I'm going to give Tim just a little snippet here to do regarding that particular question.
Well, very easy to answer
5,000 companies, Tim, don't you?
we only have private companies in the portfolio.
It's easy for me. We only have public.
So 5,000 looked at, and then you only come down to the minus 1%.
Yeah, so I mean, everything, our job is to give access to the inaccessible. Our job is to filter and provide our public market shareholders opportunities to businesses that they wouldn't ordinarily have any opportunity. Of course, if it goes public, our default view would be to sell that into the IPO, unless there was a good reason. But we are, not public market investors. Don't back me if we launch a public markets fund. We'll stick to what we know and what we think we're experts at, which is backing high-quality private fintech companies.
Brilliant. Ladies and gents, that's the end of this panel. Thank you ever so much for Kirsty, Tim, and Mike.
Right, great to meet you.
Pleasure.
Kirsty.
Thank you. Nice to meet you.
Was Joe Saluti?